Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I know I was reading through the comments section. I did a real estate clip. Someone said, hey, why don't you show us the data on real estate? So what I've got behind me is some data on why I think a big real estate boom is coming and that inventory is going to remain tight, and that it started in 2009, 2010, where at that point, inventory was very high. We were slowly dwindling it down. And now we're in a situation where we have very low inventory numbers. We have large demand, not enough supply. That's why the inventory numbers are low. So I've got the data behind me. I'll go over it. I'll go over the cycle, the real estate cycle, and then housing starts, active listing counts. I'm going to go over some data from articles and whatnot. So let's jump into it. And this is what I've got here. So what I have in the upper left here is there's 4 phases that move in a continuous wave pattern that looks like this. Here's the market cycle quadrants. We have a recovery phase, an expansion phase, a hypersupply phase, and then a recession. The middle of this graph is the long-term occupancy average. So whenever you're below the average but increasing, that's a recovery phase. Once you break through the average, you go into an expansion phase. When you're above the average and you start to decline and your inventories basically get replenished, you go into a hypersupply phase and you overbuild. And then you go into recession where you fall back down, and that is a deleveraging or deflation, and that's where we have our recessions, the big blowout recessions. Now, in each one of these phases, you want to invest a certain way. In a recovery phase, this is really good because you've got low interest rates, low inflation. And this is where stocks and bonds do very well, usually stocks. I would be invested in stocks, particularly tech companies, because if you're coming from a recession and interest rates get lowered, that's where PE ratios start to blow up again. And we've been in a recovery phase for a very long time. I can show you that in the next chart. When you go to an expansionary phase, that's more of an inflationary period. That's a credit expansion phase. That is where we build a bunch of new homes. When we build new homes, it is inflationary because it expands the credit supply. Over 60% of the loans from commercial banks go against residential real estate. And if a large portion is new homes in an expansion phase, that is new credit creation, and that loan against the house is a new loan against a new asset, which is inflationary. In an expansion phase, energy, commodities, precious metals, that's where you want to be for an expansion phase. And then you overdo it. They build too many homes. The steam runs out, the demographic runs out, where we have a mismatch between supply and demand. Inventories get replenished, and you want to be in bonds because this is where your deleveraging happens, and where interest rates, where they were increasing in this area, are now going to decline because the demand for credit's going to go down, and you're going to have a deleveraging event. So looking at the new privately owned housing unit starts that I have right here, this is the cycle. We have the long-term occupancy average in the green line going across. And the housing starts, we're just looking at the cycle through the housing starts go up and down over time. Up and down over time. We go from recessions, which are all in the red, and the back half of the red is a recovery phase when it goes back up. And then we go into an expansionary phase all the way up until we start to decline, which is a hypersupply phase. One thing I noticed over time is that every time we have an alignment, that's what these circles are, where commodities are cheap and we have an expansion phase of real estate, that's when commodities revalue themselves against stocks. And they did the revaluation from here. It actually did a double revaluation, here to here, here to here, from here to here, and we threw another buy signal right in our expansion phase that we're starting now. Now notice something on the right-hand side is that we had this massive problem in the real estate market. That's why this area under the curve, this red area, is so massive. Is this phase before it, we had, I would say, a artificial boom in real estate where we built too many homes and we gave out a bunch of bad loans, which ended up in underwater scenarios where the house went down in price, but the people owed more on their mortgages than the house was worth, and they just said, take the house, I don't care. They foreclosed on it. What happened is all these foreclosures screwed up the housing market. It screwed up the new housing builds, and we didn't build enough homes in this time period. That's why there's so much red here, where we ended up with a huge deficit today in homes. And I'm going to go over how big that deficit is and how it's going to impact everything. Now, I'm going to scroll over here real quick. This is the commodity to stock ratio. Whenever it's really low, you want to buy commodities. When it's really high, you want to sell your commodities and buy stocks. So we are at very low levels. And right now we are at an incredibly low level. And these circles here, these buy circles and sell circles, I put those on this housing real estate starts, and that's what these circles are. And it aligns with the expansionary phases of real estate and that inflationary push where commodities are in favor over stocks because of the inflationary environment. And whenever the valuations align with an expansion phase, that's when it's go time, and it's go time right now. It's totally go time. Now, looking at, what I'm saying is an expansion phase is coming, and that we have low inventory. And that is true. Here's our active listing count. Now, actually, let's go to this one in the middle here first. This is month supply of homes, and I just grabbed it for one zip code. And it's a representation, easy to see, of basically what happened everywhere across the nation. It's just a little bit different numbers. We had a massive build in inventory before the 2008 crash. You could see this thing coming all the way up. It was just beelining higher. And whenever you get above, I would say 6, 7, you get above 10, 10 means you've got a problem. Well, you've got a problem. We blew through 10 like it was nothing. The crash happened in late of 08. That was about right in here when the crash happened. So you could see through the housing starts and the inventory going up that you had a problem. And then in 2010, that inventory started to get worked off. Came all the way back down. In 2013, that's basically when we started, I would say, more of a normal market. And what happened here is we continued to draw down inventory the entire time, and we were at incredibly low levels of inventory in 2021. This is why the housing market's on fire. We have no inventory. The real estate market and housing starts isn't coming back up. We're struggling with supply chain shortages and labor shortages. Now here's the real active listing count from realtor.com. And what you're seeing is over time, this is your active listing count, and this is your time. And these are the years. 2016, 2017, 2018, 2019, 2020, 2021. We are continuing to eat through inventory with time. Our inventory is not being replenished. We have to build a lot more new homes, and we're not able to do that with supply chain shortages and labor shortages. So the real estate market is going to, in my opinion, is going to continue to go higher because of this data here, because of the inventory. And here's the existing homes months of supply. Again, this thing has been kind of a normal level here. We shot way up with this big old problem which we could tell the problem before it crashed in '08. Here's your problem coming right here. It's coming right up. We got to 11 months inventory, and then we came all the way back down, and I put a little red line in here. We're all the way down at like 2 months. And here is the days on the market from Realtor.com. This is an incredibly low level right now where we're at in September here. So we've declined over time, decline. This is 2021 where we are super low, which means our inventories are low and we're moving the inventory faster when it hits the market. We have a supply problem. Demand is high, supply is really, really low and very tight. On the right-hand side here, I'm going to read a couple of things here for you. It says, construction of new housing in the past 20 years fell 5.5 million units short of long-term historical levels, according to NAR. It's calling for a once-in-a-generation policy response because we're so short in the housing market. 5.5 million units are short. The industry lobbying group said it hopes the report, which was released Wednesday, persuade lawmakers to include in housing investments in any infrastructure package. U.S. builders added 1.225 million new housing units on average each year from 2001 to 2020, according to the report, which is this area here is what they've added. It says the figure is down from an annual average of 1.5 million, that's this green line, units from 1968 to 2000. The 5.5 million unit deficit includes about 2 million single-family homes, 1.1 million units in buildings with 2 to 4 units, and 2.4 million units in buildings of at least 5 units, the report says. The scale of the problem is so large. Now here's another one that says the U.S. has a deficit of more than 5 million homes. This is from another article. As builders have been unable to keep up with demand over the past decade, about 12.3 million households were formed in the U.S. from January 2012 to June 2021, but only 7 million new single-family homes were built during that time. The number of U.S. homes for sale is near a record low, with a widening gap between supply and demand. A severe labor shortage and supply chain disruptions that pushed up material prices are suppressing new housing starts. Land costs have risen as well, and demand has been fueled by people seeking larger dwellings during the pandemic. Household formations have been outpacing new construction long before COVID. So this problem, and you can see it in the inventory of all these things declining over time, COVID had nothing to do with it. It did not. This was in motion from 2010, just to let you guys know. Now here's another thing. Goldman Sachs, this was an article that just came out. Goldman Sachs, home prices will rise another 16% in 2022. That's their opinion. That's a huge number. Now here's another one. It says, America is short more than 5 million homes and builders can't make up the difference. That was September 14th, 2021. Here's some of the key points. And that was the 12.3 million households. Single-family home construction is running at the slowest pace since 95. Pulte Group just lowered its Q3 and full-year guidance for home closings, citing supply chain disruptions. So that right there is the housing market at a glance, so to speak. We have inventories continuing to dwindle down, demand up, supply down. We are in an expansion phase of real estate. You can see it in the housing starts. Right, that's right behind me. We have ultra low inventory, ultra fast movement on days on the market of that inventory. We have an alignment of the commodity bull market right at the beginning of the expansion phase, which has happened every time we've had a massive commodity bull market. So what does this all tell me? It tells me that we're in the right spot, that real estate's going to continue to go higher. And people on YouTube who are selling the narrative that this is going to go down, I don't know what data they're looking at. It is ultra confusing to me because this paints a picture to me that we are in a huge supply crunch in real estate and that prices could go vastly higher. And I've watched some other people who actually know what they're doing on YouTube. One of those guys, he's not well known. What's his name? I can't remember his name. But he said that it's possible that we could see from the bottom a 700% increase in real estate during this cycle. And I believe them. And if that happens, it's going to be incredibly inflationary, because last market, we basically filled the bank's coffers, so to speak, with cash. We recapitalized the banking system. That capital is not going to sit in the banking system doing nothing in an inflationary environment. They're going to loan this stuff out. They're going to say, get it out of here, make loans, build some new homes, and it's going to be highly inflationary. It's going to put incredible pressure on interest rates to go up. And if that happens, the last recovery phase, when they were printing all this money and it couldn't get into the system, all that money went into stocks and bonds. If that money rotates back out into commodities, and that's what the ratio is telling us with the commodities stock ratio, is that money is going to rotate back into commodities at some point, and that valuation is going to change dramatically. And we're seeing that ratio change. If you look at some of my previous clips, that ratio change and rotation of money will be one of the biggest opportunities in our life, if you can ride it from bottom to top in commodities. And commodities do it very quickly. They do it much faster, the change much faster and much more dramatic, because they're a lot more volatile, and the finances of these companies are going to change so dramatically with prices going up, oil prices, uranium prices, whatever it is, that we could see massive gains very quickly. And all you have to do is identify the stuff I've got behind me, watch these metrics, and just ride it. That's it. And that's what I'm doing. I'm not buying in and out. I'm not selling stuff. I'm just riding it higher. And all of the conditions are aligned. They were like this, and now they're like this. They're all lined up. And when they're lined up, that's when you hold, you sit tight, and you make your money. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.